Welcome to the debate. Imagine hitting send on a routine commercial invoice, and instead of going to your client, it goes directly to the government.
Right, and if a single data field is wrong, or specific regulatory code is missing, the invoice is instantly rejected.
Exactly. Your client never receives it, the payment is delayed, and, potentially a fleet of delivery trucks sits idle at a border crossing because legally that transaction does not exist.
Wow, yeah, it's a harsh reality.
It is, and that is the reality of continuous transaction controls, or CTC. For decades, the indirect tax function operated on this really comfortable calendar. We had the monthly value-added tax returns.
Right, and we had the quarterly intrastat filings, those statistical reports tracking trade between jurisdictions.
Yeah, exactly. We had time to review data, find mistakes, and fix them before anyone outside the company ever saw them. But, well, that calendar is currently being dismantled.
And the driver behind this dismantling is, frankly, pure, undeniable mathematics. If you look at the European Union alone, the VAT gap, which is the difference between what governments are legally owed and what they actually collect, has historically exceeded $100 billion annually.
$100 billion. It's staggering.
Right? Traditional retrospective audit enforcement simply cannot close a gap of that scale. The volume of global transactions is just too immense. And the traditional audit cycle of, reviewing paper or digital records years after the fact is just far too slow.
Governments realized they were losing billions to fraud and administrative errors, mostly because they were always looking backward.
Precisely.
So the policy response to that fiscal problem is CTC. Governments are closing the gap by validating every single invoice at the exact moment of issuance.
Which means transmitting transaction data in real time, usually as like a structured XML file sent to a central government clearance platform.
Right, which renders non-compliant transactions functionally impossible. The clearance portal issues a unique identification number, and without that number, you just don't have a legal invoice. It moves the point of compliance from the end-of-month reporting period directly to the individual transaction in milliseconds.
Oh, absolutely. And we completely agree that CTC is irreversible. It is a permanent structural shift in global taxation. But where we diverge, and what we really need to unpack today, is what this means for the tax professional.
The central disagreement.
Exactly. Does this shift mean the tax function must fundamentally reinvent itself? Does a tax director now need to become an architecture owner who governs enterprise IT systems?
Right, and I'll be arguing that yes, tax professionals must fundamentally reinvent themselves as upstream compliance architects.
And I'll be arguing that their core value remains rooted in sophisticated regulatory interpretation, managing complex edge cases and providing the logic governance that these systems desperately need, not serving as IT architects.
Well, I see the premise of the traditional tax role, but the shift from a periodic calendar to transaction-level compliance, it demands a structural transformation. In the old world, your relationship with data was entirely retrospective. You're essentially a data reviewer.
Right, downloading the month's data.
Exactly. Operational systems generated the data, it accumulated over the month, your team downloaded it, caught the errors, posted manual journal entries, and filed the return. But under CTC, that sequence is completely inverted.
Because there's no time for review.
Right. The data must be absolutely correct at the point of the transaction. A data quality failure in the Enterprise Resource Planning System, the ERP, is no longer an internal accounting problem. It is a compliance failure with immediate severe external consequences. Therefore, tax has to step up as data governors, architecture owners.
I come at it from a different way. I don't disagree that the sequence of compliance is inverted, but demanding that the tax function become architecture owners is a massive misallocation of specialized expertise.
How so?
Well, first, it's worth noting from the evidence that periodic obligations are not vanishing overnight. Many of those summary returns will persist alongside these new real-time systems for years. But more importantly, we really need to understand what automated systems actually do.
They process data.
Right. They handle routine processing. They do exactly what they are programmed to do millions of times over.
The tax function's critical role in this new ecosystem is providing the precise regulatory logic to configure those systems.
Just the logic?
The logic, and then providing the exception intelligence to handle the nuanced rejections that automation inevitably misses. Tax professionals are the translators of global regulatory logic. They are not the owners of the enterprise technology stack.
I have to push back on that premise because I think the definition of a compliance failure under CTC fundamentally shifts where the boundary of ownership lies. In the past, a compliance failure was just a quiet realization in the tax department.
You found a discrepancy and fixed it.
Exactly. You fixed it, you moved on. Today, a compliance failure is public, it is real time, and as I mentioned earlier, it literally halts commerce. Because the nature of the failure has changed, the nature of prevention has to change. Think of the old tax function like the editor of a daily newspaper.
Okay, an editor.
You could catch a typo at 11 p.m., correct it, and the morning edition will be flawless. Under CTC, you aren't a newspaper editor. You are the producer of a live television broadcast. If the script is wrong, the mistake is broadcast instantly to the government.
So you're saying the foundation has to be flawless.
Yes. You cannot inspect your way out of a fundamentally flawed data model. Therefore, you must be in the room during the ERP design sessions. You must dictate the requirements for the data orchestration layer, that critical digital traffic cop that standardizes and routes data. If you don't own those architectural requirements, well, the failure is built in.
I'm sorry, but I just don't buy that framework. Let me tell you why. Specifying requirements is not the same thing as owning the architecture.
It's pretty close, isn't it?
Not at all. Yes, the data model in the ERP dictates whether a transaction will clear the government portal. If document type classifications are incorrect, the failure is built in. I concede that point, but look closely at what the material actually requires of the tax function.
It says they need to define the logic.
Exactly. It explicitly states that tax must specify logic updates precisely enough for implementation by technical teams. That is a crucial distinction. Your responsibility is to define what a compliant invoice must contain.
But who built it?
The IT department. The systems engineers. They are the ones who actually build, own, and maintain the software and the data management infrastructure. If you try to assume the mantle of an IT architect, you are stepping drastically out of your domain.
I wouldn't call it stepping out of the domain.
You are the showrunner dictating the script for that live broadcast, absolutely. But you are not the broadcast engineer maintaining the transmission towers. You tell IT, here is the exact regulatory logic regarding VAT applicability for this cross-border transaction. The technical team builds the architecture to execute it.
That sounds great in theory, but look at how technical teams actually operate. I'm not convinced by that line of reasoning, because you are artificially separating the logic from the system that executes it.
Am I? They seem pretty distinct to me.
In a CSTC environment, they aren't. The ERP system and the invoicing platform are no longer just operational tools. They are compliance infrastructure. If you're a tax director listening to this right now, you know exactly what happens when IT implements a logic rule without understanding the nuance of indirect tax.
Well, sure, there can be miscommunications.
It's more than miscommunication. If you just hand over a spreadsheet of logic rules and say, go build it, and IT implements it with an orchestration layer that cannot standardize the data fields correctly, who gets called when the government platform rejects 1,000 invoices on a Tuesday morning?
Tax does.
Tax does. You cannot just be a consultant to your own compliance process. You have to own the architectural specifications to ensure the system is substantially correct, not just operationally functional.
But let's follow that through to its practical conclusion. Let's say IT builds this robust foundation based perfectly on your specifications. What happens when the real-world transactions don't fit perfectly into that automated foundation? Because, they never do.
Well, you optimize the system.
But as routine CTC submissions become increasingly handled by automation, the human attention of the tax function has to shift somewhere. It shouldn't shift to maintaining IT architecture. It must shift to what the material calls exception intelligence. When an invoice is rejected by the pre-clearance model, it's rarely because the system architecture is broken. It's because the reality of business is messy.
How so? Give me an example of where a perfect system still fails.
Okay, consider a complex cross-border supply chain. Company A in Germany sells to Company B in France, who immediately sells to Company C in Italy.
Ah, a classic triangulation scenario.
Exactly. But the physical goods ship directly from Germany to Italy. An automated ERP system sees the billing addresses and throws a generic cross-border rule.
which might trigger a local reporting rejection because it doesn't recognize the specific triangulation simplification rules.
Because it lacks the context.
Right. It cannot reason through the ambiguity. Analyzing those rejection patterns, diagnosing the root causes, and resolving them requires deep analytical capability. You don't need a systems architect to fix that. You need a deeply experienced human tax expert to look at that specific routing and apply the nuanced regulatory logic. That is exception intelligence.
I see why you think that, but let me give you a different perspective on exceptions. Exception intelligence, as you're describing it, is often just downstream triage, disguised as a strategic function.
Downstream triage?
Yes. Triangulation is complex, absolutely. But if your upstream architecture was designed properly, if you govern the data model so that the supply chain module inherently flags drop shipments and maps them to specific tax condition records before the invoice is even generated, you drastically reduce those very exceptions.
You can't account for every single variation, though.
Maybe not every single one, but the material points out that the tax function that waits for data to come out of the ERP will always be managing failures. If you are spending your week analyzing rejection patterns from French and Italian tax authorities, you have failed at the architectural level.
I think that's a bit harsh.
Excellence in manually fixing edge cases is preparing for a world that is ending. Governing the architecture keeps the vast majority of transactions compliant automatically.
I wouldn't call diagnosing complex regulatory edge cases downstream triage. I'd call it the fundamental purpose of a tax professional. Automation handles the routine 95% beautifully, but that remaining 5% carries the highest financial and operational risk.
True. The risk is concentrated there.
Right. And minimizing those exceptions isn't just a matter of having a clean architecture today. No system is static. You can build the perfect architecture this morning, but what happens when 3 different countries change their XML reporting requirements tomorrow? This is why the regulatory horizon outweighs static architecture.
The mandate storm.
Exactly. We are in the middle of a global mandate storm. CTC frameworks are not a localized phenomenon. They are rolling out globally at an accelerating pace.
It seems like a new country announces one every month.
Right, and the pattern is incredibly consistent. A government announcement, followed by a phased implementation, leading to a full mandate. Organizations typically have a preparation window of 12 to 36 months.
Which sounds like a lot, but it isn't.
It flies by. The absolute highest return investment for a global indirect tax team is regulatory horizon intelligence. Tracking government consultations in Malaysia, monitoring implementation announcements in Poland, analyzing technical specification updates in France, that is pure tax expertise.
But if they don't have the systems...
If your tax leadership is bogged down in the trenches of ERP system ownership, they miss the horizon. They stop looking outward. And when you miss that 36-month window, your organization is left scrambling, treating a massive regulatory shift as a last-minute IT crisis with only weeks to prepare.
That's an interesting point, though. I would frame it differently. I completely agree that systematic horizon monitoring is critical. Tracking technical specifications across dozens of jurisdictions is non-negotiable. But here's the stark reality.
Go on.
That regulatory intelligence is completely useless if you don't have an architectural approach ready to absorb it. If you are just monitoring the horizon, you are just watching the storm roll in.
But you are watching it with enough lead time to prepare the business.
Prepare how, exactly? By launching a massive isolated IT project for every single new country mandate? By building a bespoke point-to-solution for Romania and then another one for Spain and another for Japan?
Well, you adapt as needed.
That is exactly what happens when tax doesn't own the architecture. The correct response to the mandate storm is to build a core compliance architecture that absorbs new mandates through configuration rather than project-based implementation.
Meaning a single hub?
Yes. One compliant data model in the ERP, one centralized data orchestration layer, configurable compliance logic for each jurisdiction that plugs into that central hub. That is an architectural approach, and demanding it is a tax leadership decision, not an IT one.
It is a collaborative decision, surely.
It is led by tax. And furthermore, if you focus solely on the regulatory horizon and exception handling, you miss the ultimate prize detailed in the material, which is data intelligence.
I'm curious how you define the boundary there, because data intelligence usually sits far outside the tax department.
Not anymore. Think about what CTC actually creates. Real-time transaction controls require a comprehensive, validated, machine-readable record of every invoice-level financial event the organization processes.
Because the government is verifying it all.
Right. Because the government validates it, it becomes a single source of truth. This record is richer, more granular, and more timely than any financial data source that previously existed in the enterprise. If tax owns the architecture, they can extract and standardize this data.
To do what with it exactly?
Imagine walking into a treasury meeting. Instead of saying, here is our estimated VAT liability for next month, you can say, based on our real-time clearance data across 30 jurisdictions, here is our live cash flow position. Here are our exact refund and payment positions.
Oh, wow.
Right? You can monitor counterparty compliance status. You can provide transaction-level supply chain visibility. These are not tax outputs. They are massive organizational intelligence assets. By owning the architecture, the tax function routes this intelligence to the CFO, fundamentally elevating tax from a back-office compliance center to a strategic advisor.
That is a compelling vision, but have you considered that treating data intelligence as a tax mandate blurs the lines of enterprise responsibility to a dangerous degree?
I don't see it as dangerous.
I do not dispute that the data generated by CTC processes is a goldmine. The material is very clear that this data exists as a byproduct of the compliance process. But extracting that data, structuring it, and building dashboards for the treasury team to optimize cash flow is traditionally the domain of enterprise data scientists and financial analysts.
But they don't understand the tax logic that structures the data.
Perhaps not initially, but they understand data engineering. The tax professional's primary mandate is regulatory adherence. If a tax director pivots entirely toward becoming a data broker for the CFO, they risk diluting their focus on the very complex, rapidly shifting regulatory landscape that generated that data in the first place.
You think it's too much of a distraction?
I do. You can be acutely aware of the data's value, and you should absolutely collaborate with data science teams to unlock it. But suggesting tax must build or own the architecture to extract it is mission creep of the highest order.
I don't see it as mission creep at all. I see it as survival. I see it as evolution. If the traditional compliance calendar is ending, the traditional metrics of success for the tax function, producing accurate, on-time returns, are ending with it.
Well, the mechanism is changing, certainly.
The government is essentially doing the return for you in real time. You need a new value proposition for the business.
The value proposition remains what it has always been, protecting the enterprise from non-compliance and financial penalties in a world where the rules are fiercely complex and constantly changing.
But the medium
has shifted from a static monthly spreadsheet to a real-time government server, yes, but the core function is the same. To assess an organization's operational readiness for this new world, you have to look at whether they have a systematic process for monitoring those emerging mandates with sufficient lead time.
and governing the systems.
Right. You have to look at whether they are rigorously governing the logic implemented in those automated systems. Because if you fail to maintain precise logic governance, your beautiful, unified orchestration layer will flawlessly execute the wrong tax treatment thousands of times a second.
But again, it is a symbiotic relationship. If you don't have data quality at the source, if the transaction data generated by the ERP isn't complete, standardized and structurally correct at the exact moment of creation, your logic governance doesn't matter.
It certainly makes it harder.
It makes it impossible. The transaction will be rejected, the invoice won't issue, and the business will stop. It all comes back to how the system is explicitly designed to generate and route data before the invoice ever leaves the building.
And it all comes back to who is deciphering the specific, localized rules that dictate what that exact invoice must look like to satisfy a foreign tax authority. A system architect cannot tell you that. Only a tax expert can.
Well, as we step back and look at this entire landscape, I return to the fundamental reality that the era of periodic compliance is ending. The massive global VAT gap has forced the hand of governments, and the policy response of continuous transaction controls is permanent.
We are certainly in agreement there.
To survive and thrive in this environment,
The indirect tax function must evolve beyond its historical identity. It can no longer be a downstream, retrospective reviewer of data. It must embrace a new identity as the organizational architect of continuous compliance.
which is a heavy lift.
It is. It means stepping out of the tax silo, taking ownership of the architecture requirements, and ensuring data is structurally correct at the point of creation. And by leveraging that robust foundation, tax can generate not only perfect regulatory adherence, but unprecedented strategic business intelligence for the entire enterprise.
And while I agree wholeheartedly that the technological medium has shifted definitively to real-time systems, I maintain that the irreplaceable core of the tax profession remains rooted in regulatory expertise, not IT architecture.
Fair enough.
The tax function must certainly collaborate closely with technical teams to ensure systems are built correctly. But its ultimate, irreplaceable value lies in translating incredibly complex, shifting global regulations into governable logic. It lies in maintaining rigorous horizon intelligence to navigate the mandate storm. And, in providing the human exception intelligence necessary to resolve the inevitable edge cases that automated systems simply cannot reason through alone.
We certainly share the agreement that the stakes have never been higher for tax professionals. The transition to CTC is not just an incremental software update. It is a structural transformation of global commerce.
Truly.
The compliance calendar is officially being replaced by the compliance transaction, and the penalty for failure is no longer a delayed reporting cycle or an audit 3 years from now. It is an immediate hard stop to business operations. The tax function simply can no longer operate in the background, cleaning up data after the fact.
Absolutely. On that point, there is no debate whatsoever. The organizations that wait for this new reality to impose itself will be permanently stuck in reactive, frantic catch-up mode, treating every new country mandate as an emergency.
While the leaders move forward.
Right, whereas those that proactively design their response, whether through system architecture or rigorous horizon logic, will define the standard for operational resilience.
Looking at this structural transformation from both the systems engineering perspective and the regulatory intelligence perspective highlights just how multifaceted this challenge truly is. There is certainly much more to explore regarding how organizations will practically assess their operational readiness across the various jurisdictions, rolling out these mandates over the next few years.
It's going to be a busy decade.
Oh, definitely. But it leaves us returning to that question of identity. As the monthly compliance calendar fades into history, the tax professional is standing at a crossroads. The lingering question for every tax leader isn't whether real-time compliance is coming, but whether they will be the one writing the rules that govern the enterprise's foundation, or merely the consultant waiting downstream to handle the exceptions.